This is the first of 4 sessions in which we will be discussing corporate governance and specifically King 4. In this session, we are going to understand the apply and explain regime of application that is applicable to King 4. We will also discuss the objectives to King 4 and discuss and explain the 6 capitals. This would be an introductory session, whereas the other 3 sessions will go a bit more in depth. So when we talk about corporate governance, what are we talking about? Corporate governance is the way in which a company acts. Which company, you may ask? All companies. It is the way in which a company's management acts and the way in which the company interacts with its environment. In order to have good corporate governance, we have to have a strong board of directors. For the purpose of these sessions, we will be referring to the board of directors as the governing body. The governing body needs to have clear and ethical leadership. Also, setting specific goals and leading by example can assist the governing body to create an atmosphere of ethics and an atmosphere of good corporate governance in their firm. Why is the King Code structured in the form of a code? Firstly, we need to understand how a code is different from laws or rules. The King Code is not law. Therefore, it is not binding to any one firm. As a result, the King Code is voluntary. This means it does not prescribe methods that need to be applied in order to achieve corporate governance. Instead, it gives us recommended practices or simply suggestions. This is a critical aspect of the King Code because when we allow people to make their own decisions about corporate governance, we actually gain insight into what the people actually believe is important. For example, someone that views corporate governance as being very important will place a high value on their good corporate governance. And as a result, you will find that such a person or such a firm will go to extreme ends in order to ensure that they achieve good corporate governance. On the other hand, someone that is not too focused or too interested in corporate governance will only do the minimum that is required. It is important to note that practicing the recommended practices in King 4 does not necessarily mean that good corporate governance will always be achieved. So, a code can have rules or principles for application. Rules require compliance, whereas principles require application. What is the difference? When we use the word rules, we often think about breaking the rules. And whenever a rule is broken, there always seems to be a punishment. So there's almost a compelling to obey or listen to a rule. This is not the line that King 4 has taken. Instead, King 4 has opted to go with a principle framework, which means that it allows the individual companies and boards of directors to express themselves more freely. It also allows flexibility and adaptability for differing situations. This tackles one of the main challenges that arise when creating rules for a large set of companies. Is that when a rule is made, it may not be applicable or practical for all companies that it applies to. As a result, principles are used instead of rules in the King Code. King Code follows an apply and explain framework. Apply and explain is critical. The most important word for our purposes is the and. This means that an entity is encouraged to apply the King Code, but also explain how they applied the King Code. This allows an entity to express themselves critically and evaluate their own performance in order to assess whether they have met and achieved the principle. With this regime, we find that the application of principles is assumed. So there is no question of whether or not application is conducted. Instead, application is always assumed. That means that everyone is assumed to have applied the principle. But there may be differences in the method or the way in which the principle was applied, and as a result, an explanation is required. Notice also that the explanation is not optional. You have to explain how you applied the principle. With regard to explanation, the explanation of how a principle has been achieved must be made publicly. It does not always need to be made in the financial statements, but the statement or report that is generated in order to indicate how King 4 has been applied must be freely available to all stakeholders. This may mean that you have a separate report on your company's website, or you may post it to specific stakeholders and shareholders, but you must account for how you have applied King 4. King 4 encourages that if the explanation is done in a separate report, that all other reports are cross-referenced into this report. This means that the information on how an entity has applied and explained the King 4 is available in one source. Therefore, stakeholders are not confused or do not find it difficult to find this type of explanation. How is this different from previous regimes or frameworks used by the King Committee? Previously, before we had apply and explain, we had apply or explain. This indicated that there was a lack of accountability because not everyone was required to apply the principle. Instead, you could simply explain the principle away. This new regime or framework of application blocks that loophole, meaning that entities are no longer able to explain principles away. It also prevents entities from following a checklist application. A checklist application is where an entity, probably at the last minute before their financial statements is reported, goes through the King report and then just ticks off that everything has been applied. Maybe that is because previously the principle had been applied, or the person preparing the report may be new and not know the entity entirely. But with an apply and explain framework or regime, the person preparing the report is required to dig deeper and to understand how principles have been applied. As mentioned before, apply or explain had a lack of accountability and led to checklist applications. Good governance is good for all stakeholders, not just shareholders. And when the board of directors is required to explain how they met a requirement, it can result in a more profitable firm, more return on shares, but also it is for the benefit of all stakeholders. When an entity has a good governance record, it results in a decrease in the cost of capital, meaning that banks and other lenders are willing to lend the company more money at a lower cost. This can result in higher efficiencies and also result in the entity growing. It is important to note, King 4 is not law and is applicable to all companies that wish to apply. However, the Companies Act, together with the JSE, has made it compulsory for all JSE listed entities to apply King 4. This is because governance is a criteria for a company to be listed on the JSE. Good governance, that is. So why did we need King 4? As many of you know, King 4 is the fourth iteration of a report that was first released in 1994. That was called King 1. Since then, we have had 3 different reports, and the latest is called King 4. So why did we need the change? The first is that the previous report did not account for the financial crisis that took place in 2008. This meant that specific rules for banks as well as for lenders of credit were not included in King 3. As a result, a change was required. There is constantly change in the business environment, and the previous report had become outdated because ways and methods of doing things had changed so dramatically. These are some of the changes that you may see in the business environment around you. Credit pressures. Public requiring more accountability. Policies of South Africa and the world. Inequality is particularly important in South Africa. Environmental pressures. Inflation. New technologies. Credit ratings and credit rate changes. Because the previous report was compulsory to be applied by so many entities, if the previous report were not changed, many companies would have suffered negatively. As a result, the change allows entities to be more flexible and therefore adapt to their changing environment. The 2008 financial crisis had shed the spotlight on the actions of directors and leadership of companies. Directors need to act in a way that ensures that their company is valuable to society and not just valuable to the shareholders. If you think back to 2008, the corporate failures were because Lehman Brothers were not willing to think of people buying unsecured debt. VW and their diesel engine scandals is where the board of directors knew that diesel engines were emitting dangerous chemicals into the air. Aurora Mines, which happened a couple of years ago, was related to state capture, and SAA requires a bailout every 18 months or so. The King Code is not the only code in the world. There are other governance codes, and as a result, King Code needed to be changed in order to come into line with other best practices from around the world. King Code was also applicable to listed entities and therefore was designed to meet the needs of listed entities. But because of the changing environment and the increasing number of SMEs in South Africa, the King Code report needed to be amended so that it is more applicable to SMEs, NPOs, state-owned entities, as well as municipalities. The changes in King 4 allow that to happen. King 4 is now targeted towards the outcome of governance. As a result, we find a total change in the application. So we move away from rules and we now enter into principles as well as recommended practices. King 4 was released late in 2016 and is effective for all year ends after 1 April 2017. Alternative dispute resolution. Alternative dispute resolution is simply a practice of settling disputes. This is to ensure that entities do not have to go to court continuously in order to resolve the disputes that they have with other entities. Instead of going to court, entities will go into mediation or arbitration. That means that a third party will be invited and discussions held in order to find a resolution to issues. The board will have a duty to resolve these issues efficiently and effectively. So why did we talk about alternative dispute resolution when we're talking about King 4? This is because part of King 4 is also acting ethically towards your society and your environment. So, if an entity is unable to resolve the disputes that they have with the environment and society around them, you will find that the entity will not last very long. King 4 encourages entities, together with their governing bodies, to resolve disputes using the alternative dispute resolution. Let's move on to the outcomes of King 4. So what does King 4 attempt to achieve in an entity? I have created an acronym to ensure that you remember what the outcomes of King 4 are and that it is easy to remember. Let's look at the acronym. The acronym is MOCHA. MOCHA is a type of coffee. Many of you may know what a cafe mocha is already, but here are some pictures of what you will find when you Google cafe mocha. So, M in MOCHA stands for meaningful and transparent disclosure. King 4 was attempting to promote meaningful and transparent disclosure of the way an entity hopes to achieve their governance. Not only that, they want to ensure that all stakeholders who are interested in the governance of an entity are able to access this disclosure. Most companies that you guys will encounter are profit generating companies. That is the ultimate outcome or goal of the company. Good corporate governance helps to achieve those outcomes. So, part of the purpose of King 4 is also to achieve the outcomes of the entity. What does the CH stand for in MOCHA? As mentioned already, entities do not exist in a bubble. Instead, they exist in the society and environment around them. So if they are conscientious or if they think about the way their actions will affect the entities around them, they are able to ensure that their actions do not harm anyone and their actions are in the best interests of all. Understanding that corporate governance is not something that just happens in the boardroom, but something that happens on a daily basis by every member of an entity is important. So King 4 was created in order to try and promote a holistic or integrated way of looking at corporate governance in an entity. What does the A stand for? The A stands for making the acceptance or adoptance of King 4 widely available, meaning that many different organizations that are not necessarily listed organizations are able to adopt and use King 4. These were the objectives of creating King 4. King 4 starts off by indicating what is the purpose of a board of directors. In order to do that, they talk about the board of directors' responsibilities. Let's look deeper at that. So that we remember the governing body's responsibilities, I have made an acronym called SOAP. If you don't know what SOAP is, here are some pictures. So, governing bodies are required to provide strategy and leadership for their entity, but particularly strategy and leadership in areas of governance. Governing bodies are not only meant to create policies or plans to ensure that governance is achieved, but also oversee and monitor the implementation of such policies. Governing bodies must ensure that they hold themselves as well as their entity accountable. They do this through governance, reporting, and disclosure. As mentioned under O, governing bodies are required to create policies or plans to achieve corporate governance. Let's look at the characteristics of good governance. Firstly, ethical leadership. Ethical leadership is the foundation of good governance. There are 4 values that we must take into account when considering ethical leadership. The first is responsibility. Entities must take responsibility for their assets as well as their actions. And if need be, they may need to correct their actions. Accountability. Entities must be accountable to all their stakeholders, not just their shareholders. Entities and boards need to act fairly towards all stakeholders, ensuring that no one stakeholder is overlooked in the interest of another. Boards need to achieve transparency and ensure that they keep all stakeholders well informed about the performance and sustainability of a company. Characteristics of ethical leadership are integrity. Boards must act with integrity. They must ensure that they are competent enough to tackle the responsibilities weighed upon them. A good corporate citizen is another characteristic of good corporate governance. Entities must ensure that they act as good corporate citizens. This ensures that they report timeously, but not only that they report on 3 broad metrics: economic, social, and environmental. We will get a little bit deeper into these metrics when we talk about the 6 capitals. Entities must ensure that they invest in the well-being of the economy and their environment in which they operate. They can do this by ensuring that they recognize the need for fundamental human rights in their environment. Let's move on to the 6 capitals. This is a diagram taken out of the integrated reporting framework from which the 6 capitals is extracted. If you have a look at this diagram, you will find that the entity is considered to be a process in the middle. The entity functions under a business model, so the way in which the entity is attempting to make money. There are certain inputs that the entity puts into this process, and there are certain outputs that the entity receives. However, this entire process is kept together by governance. So, ideally what happens is the entity will receive some sort of capital, let's say human capital. That means a trained individual, someone who knows what to do. Let's, for example, consider this to be a graduate. They would take a graduate into their entity, they would then use the graduate, and after, when the graduate is ready to leave the entity or when the graduate is promoted, the graduate is then better equipped and has more human capital than the graduate had before they entered into the entity. This is why we say that this is the value creation line. Entities are required to take in a whole lot of resources and improve the resources by adding value to the resources, so that when an entity moves away, there is only good things left over. Characteristics and descriptions of the capitals. There are 6 capitals that we need to talk about, and over time the 6 have grown. So when we first started with the capitals, we only had 3, that being environmental, social, and economic. Now we have 6. The first is financial capital. Now this is the capital that most of you guys are very familiar with. It is, for example, the goods and money that are used in order to create and run a business. It is the type of capital that you guys normally account for when you're doing financial accounting or management accounting. Manufactured capital is capital that the entity has created on its own. So, for example, if an entity manufactures or builds a building, that is considered manufactured capital. Intellectual capital is such things as intangibles or types of assets that were created or generated by the entity but they do not have a physical representation. Human capital, which is one of the most important capitals, are the people, competencies, skills, and experience that is contained within an entity. Social or relationship capital is the type of capital that an entity has arising from their relationships with other stakeholders that are outside their internal environment. So, for example, the community in which they operate, their relationship with the government, those are what we call social and relational capital. Natural capital are those capitals that we get out of nature, so the renewable and non-renewable sources and resources that an entity might use. These are the 6 capitals. Now, not all of these capitals will be applicable to all organizations. For example, if you have a purely service-based organization, the entity may not use natural capital, so may not use trees or those types of things. But there is some sort of link back to nature. And therefore, we say that not all the capitals are applicable to an entity in an equal form. They may all be applicable, but they are not always equal. An entity would need to analyze which capitals are most applicable to them and therefore need to report and manage these capitals. Thank you. That is the end of session 1. Please join me next time when we will dig deeper into principles 1 to 7 and explain how we are going to apply these principles in the real world.